Today's tutorial will be about general insurance markets and the external environment. Now, for both SP7 and SP8, the first few chapters are exactly the same, so this tutorial will be applicable for both modules. The first thing that we'll go into are the providers of insurance and reinsurance. So, starting off with direct insurance companies. Insurance companies provide insurance for both individuals, this is called personal lines insurance, and this covers things like car insurance, home insurance, medical insurance, and travel insurance, as well as others. And they also provide insurance for companies. This is known as commercial lines. Now, insurance companies are split or can be split into three different groups. We have composite insurance companies who write both general and life insurance. We have pure insurance companies who write only general insurance. And then we have insurance companies who specialize in a subset of classes or products. Now, the natural question that arises is why do we make the distinction between life insurance and general insurance? Well, firstly, they cover different risks. Naturally, life insurance covers events that are certain to happen, like death, but uncertain in when they're going to happen. In general insurance, we cover things like fire, like theft, which is covered, but it may or may not happen. As well as that, the duration of the contract is very different between the two. Life insurance is typically longer term, maybe 10 to 30 years, or even the whole life, whereas general insurance is typically 1 to 3 year contracts. So in summary, the reason that we distinguish between the two is that the actuarial calculations underlying these products are or require different assumptions. Moving on to the structure of insurance companies. Insurance companies may be proprietary in the sense that they are owned by shareholders to make a profit and are limited by shares, or they may be mutual, where they're owned by policyholders. We can now move on to reinsurance companies. Now, reinsurance companies provide reinsurance for insurance companies. Reinsurance companies might specialize in writing certain types of reinsurance, whilst others might write many different classes. Now, an important note is that there are many insurance companies who write both direct insurance and reinsurance. Next, we're going to look at what the London market is and the participants of the London market. The London market is part of the insurance market where insurance and reinsurance is carried out face to face. Companies are typically situated quite close to each other. The London market typically specializes in larger risks, which insurance companies deem too big to insure by themselves. For example, property, liability or casualty insurance, and risks to do with international exposure. Some of the participants include UK subsidiaries or branches of insurance and reinsurance companies, Lloyd syndicates, and we have self-insurance groups like captives, P&I clubs, and pools. We've already looked at insurance companies and reinsurance companies in detail. Now we're going to look at Lloyd's syndicates in more detail. So, what is Lloyd's of London? A syndicate is part of Lloyd's of London, so it makes sense to understand what or who is Lloyd's of London. Lloyd's of London is an insurance marketplace where brokers who want insurance for their clients meet with members, insurance companies who provide insurance. Now, these members are, as I've said, typically insurance companies who accept the liability or risks that they underwrite in return for a profit. Now, historically, these members were called names because they used to be individuals. Now, since 1994, more companies are becoming members and are now called corporate names. Corporate names typically provide capital, provide money to Lloyd's as a form of financial backing, with the advantage that they can't lose any more than the amount of capital they provide to Lloyd's. Now, a syndicate is a group of members who collectively co-insure a risk. Co-insurance is where multiple insurance companies split the liability of a risk in proportions, adding up to 100%. For example, it wouldn't be applicable here, but if I took out home insurance, co-insurance in this situation would mean that insurer A would take 50% of the risk, for example, and insurer B would take 50% of the risk as well. And so I would pay 50% of the premiums to insurer A and 50% of the premiums to insurer B. And then if I claimed on the policy, they would both give me 50% each of the claim amount. That's what co-insurance is. So these members employ underwriters to write business on their behalf, and each member who belongs to a syndicate will contribute capital and money to that syndicate and will accept a portion of the risks written by the syndicate. And then once the profit and loss emerges, it's then shared amongst the syndicate's members in that same proportion. Each member might change its proportion from year to year, but during the year it's fixed. And finally, it is possible for a member to belong to more than one syndicate if they want to diversify, but it's far more common for a corporate member to underwrite through a single syndicate. Now, in relation to their financial backing, each member provides financial backing to Lloyd's. This is called funds at Lloyd's, or FAL as an abbreviation. This might be given either by physical assets or as a letter of credit, with a letter of credit being a promise to pay Lloyd's in the future a specified amount of money. There is also a further layer of protection which Lloyd's provides to policyholders. This is called their own central fund, and every corporate member makes an annual contribution to this fund. We'll now move on to the next participant of the London market, which is self-insurance groups. Now, self-insurance groups, the definition of a self-insurance group is setting up an organization with the intention of retaining risk or keeping risk. The first example of a self-insurance group is a captive. And a captive is an insurance company that is set up with the purpose of insuring its parent company and retaining premiums and risk within the enterprise, where the enterprise refers to the collection of both entities. Now, the reason that captives might be set up is that cover may not be available elsewhere, or premiums may be volatile in the market. They might want to manage the premium expenditure of the enterprise, or they might want to take advantage of tax or regulation. Another example of self-insurance groups is a protection indemnity club. This is a type of mutual entity for ship owners in particular to cover any marine risks related to liability that wouldn't be available under a typical commercial marine policy. The largest example of a P&I club is the international group of P&I clubs. P&I clubs also provide ship owners with technical assistance because these are ship owners and they know the marine market the best. And they also provide a large proportion of the world's coverage against marine liability claims. The last example of self-insurance groups are pools. This is an arrangement where parties share premiums and claims for specific classes in specific proportions. A P&I club is an example of a pool. Now, there is a difference between insuring with a conventional insurer and insuring with a pool. In insurance, in the conventional insurance model, the policyholder's liability is limited to the premium paid, to their own premium that they pay. Whereas in a pool, members share the actual claims and costs. So a pool member's liability can extend beyond their initial contribution. So let's say a factory pays a £10,000 premium to an insurance company to cover any risks of fire. And if a major fire occurs and total claims exceed what the insurance company collected from the factory doesn't pay anything more. its liability is capped at £10,000, assuming there's no excesses or deductibles. Now, if, for example, 10 factories each contribute £10,000 to a mutual fire pool, this comes to £100,000 in total. And if total claims after a fire come to £150,000, which is more than the £100,000 collected, each member might have to pay an extra £5,000 to cover this extra shortfall. So in conventional insurance, your liability ends or is capped at the premium, but in the pool, your liability depends on the total claims and costs shared by all members. Now we're going to move on to common markets around the world. The most developed insurance markets are known in developed economies like the UK, US, Japan, Canada, Germany, and Italy. And reinsurance is more likely to be placed internationally and is more notable again, in the UK, the US, Switzerland, and Germany. Bermuda is also a big industry for insurance. Despite not being a large economy, it is an international center, like I've just said, for insurance and reinsurance. And the reasons for this is that it has a favorable tax environment and it has advantageous regulation. It is a major tourist location, and historically it has links with UK and the US. And just a side note here, many insurance companies are domiciled there because of the above reasons. Now we're going to look at the ways or the methods or the channels that insurance is bought. These are known as distribution channels. Distribution channels are simply the way that insurance companies acquire business, or in other words, sell their insurance business. Now we can look at it from the aspect of non-London market business first of all, where the first distribution channel we can see is through brokers. Brokers act as intermediaries between the seller and the buyer, and they're likely to be paid by commission or brokerage from the insurance company. And legally, they must represent the best interest of the policyholder. Another distribution channel is through a cover holder. Cover holders are sort of like binders, but instead are legal agents of the insurance company. The cover holder enters into a contractual agreement with the insurance company to be allowed to write insurance on the insurance company's behalf. This agreement is called a binding authority. This is where the insurance company essentially hands over the pen to the cover holder to write insurance on behalf of the insurance company. And this contractual agreement specifies the period for which insurance can be written, the classes covered, and any policy wordings that are used. And cover holders are likely to be paid a percentage of premium as commission. And there is potential for conflicts of interest here because they have an incentive to increase writing more business with more premiums without any regard for the profitability of the business or the risk. Another distribution channel for non-London market business is tied agents. These are third-party agents which are sometimes tied to a particular insurance company and may exclusively offer that insurance company's products. And again, they are likely to be paid commission for this service. Lastly, we have direct sales, referring to the direct sales team of the insurance company. These are staff employed by the insurer who will be paid a fixed salary as well as potentially commission. And these sales may be made over the internet, by email, or by telephone. Now we're going to look at the distribution channel for London market business with a past paper question. So for London market business, business is acquired through brokers using the slip system or the subscription system. And you can see the past paper question says, describe subscription business in the context of the Lloyd's market. So we're looking for about 10 points here. The first point to note, and the main point to note, is that subscription business is insurance written on a co-insurance basis. This is where the whole risk is divided up proportionally, and each insurance company takes a specified share of premiums and claims. This is arranged through the slip system. The broker, acting on behalf of the insured, of the insured writes the risk on a standard form. This is known as a slip. This slip is circulated around the Lloyd's market. Underwriters sign the slip to confirm the proportion of the risk that they will accept. There is usually always a lead underwriter who sets the price and the terms for the risk on behalf of the other underwriters, and the rest of the underwriters are known as following underwriters. The broker sometimes tries to overplace, meaning to receive offers for more than 100% of the risk, and in this case the proportions of each underwriter will be reduced to total 100%. And if the broker can't find enough underwriters to cover 100% of the risk, the terms of the contract might need to be relaxed. Now we're going to look at another past paper question for distribution channels. So this question asks us to define acquisition costs with an example. It also asks us to list the distribution channels and outline what the acquisition costs might be intended to cover for each channel. So acquisition costs are any cost arising from writing insurance business. The potential channels, as we've gone through before, are brokers or intermediaries, cover holders or delegated underwriters, the direct sales force, and tied agents. And the acquisition costs for brokers and intermediaries are to compensate them for introducing business, to provide admin support, and to provide claim support. In relation to cover holders, you might want to compensate them for their access to write business, again, to provide admin support, and for any policy wording and issuance. For the direct sales force, acquisition costs might be for the sales staff, for the marketing department, or for product designing. And for tied agents, there might be commission for new business and renewals, which is typically a percentage of premium. And commission is usually high to reflect the tied nature of these agents. Now we're going to look at a past paper question on Lloyd syndicates. So the question says, list the advantages and disadvantages of an insurance company writing business through a Lloyd's syndicate. We're looking at 8 points, 4 in advantages, 4 in disadvantages. So the advantages are that we can write business in many countries because Lloyd's has a global license. Lloyd's typically has a high credit rating and large capital requirements, which might be attractive to policyholders. We have access to a large subscription market, writing a diverse range of classes of business. And also being a following underwriter allows companies to build up experience over time. Now, in relation to the disadvantages, there are far more admin requirements to comply with Lloyd's regulation. An annual levy is payable for operating in Lloyd's. They might impose restrictions of the types of business that we can write. And Lloyd's accounting rules that profits are not released until the end of the third underwriting year might not be very well to adhere to, essentially. Now we're going to look at regulatory actions that insurance companies might face when doing business with a past paper question. So this question says, list and explain the purposes of the ways in which a supervisory authority can impose restrictions and requirements on a general insurance company in respect to their investment policy and their underwriting policy. So we're being asked to list and explain ways that an insurance company might be restricted in their investments and their underwriting. In terms of their investment policy, a supervisory authority might restrict the certain types of assets available that insurance companies might use to demonstrate solvency, to reduce the risk that liabilities won't be met. There might be a requirement to hold reserves if we mismatch, to incentivize matching assets with the liabilities. The supervisory authority might restrict certain foreign assets for political reasons. They may also require a custodian for overseas assets. The supervisory authority might require a custodian for overseas assets to reduce the risk of overseas assets being mishandled, I should say. They might also require the insurance company to hold certain assets from certain investments. In terms of their underwriting policy, they might restrict the type or the class of business the insurance company is allowed to write to ensure they have sufficient expertise to actually write it. They might impose limits on the premium rates to ensure policyholders are not being overcharged. There might be restrictions on the information used for premium calculations, like gender, for example, for ethical reasons. They might require agents from the insurance company to be licensed to sell insurance to ensure they have sufficient expertise to write the insurance products. They might also require a cooling off period to protect the policyholders. And finally, they might restrict the countries that the insurance company can write business in, preventing exposure to volatile risks in volatile environments. Next, we're going to look at the external environments. Now, the way we think of the external environment is through an acronym, still cubic wage. Now, the first item is seasonality. Now, this is where the risk in the policy is not constant throughout the term. Insurance companies typically take a portion of premium and set this aside as a reserve. This is usually equally split in the policy over the policy length, but it should really reflect the risk properly. Technological change. Now, this is where we have increasing capacity of computers and the internet. Technological change enables complex modeling, and we can use comparison websites to understand how policies are being sold. Investment conditions. Now, the question to ask the questions that insurance companies ask are where to invest their premiums, because premiums are typically invested until they're paid out in claims. Capital is typically split out into two groups: statutory reserves and free assets. Generally, we um, match assets with liabilities, but there is more freedom over investing our free assets. In terms of latent claims come from any perils or risks that are not foreseen when the policy was signed, and these are typically linked to liability claims, for example, asbestos. Legislation. This can affect either the claim frequency or the size, and could also impact the cost of insurance or make certain insurance compulsory. Catastrophes. We can have natural catastrophes like storms, like earthquakes and fires, or man-made catastrophes like air crashes, explosions, or terrorist attacks. Then we have the underwriting cycle, which is a cycle of high and low premiums. Generally, insurance is highly profitable, and this is known as a hard market. It's known as a hard market because it's hard for policyholders to buy insurance cheaply. Since it's highly profitable, this attracts new insurance companies into the market, and so they compete for market share. Since they compete for market share, premiums reduce or soften, causing a soft market. And eventually premiums fall to the extent that insurance companies are making a loss. And this ultimately is a soft market. In the soft market, the insurance companies leave the market, and then this lower supply of insurance leads to premium rates increasing again to the stage of a high profitability, and this cycle carries on. We next have trends, behavioral trends, which is, for example, drink driving, staged car accidents, and fraud. And this relates to any societal attitudes, essentially. We also have inflation, which typically affects the amount of each claim, which is the severity. And there are 4 different types of inflation. There's price inflation, there's earnings inflation, and there's medical inflation, and there's court inflation. And then we have court awards. This has the highest impact for claims under liability insurance. So it affects both whether a person is entitled to compensation, which is frequency, and the amount of the compensation, which is the severity. We have weather, which is a part of the external environment. Generally, in the winter, weather is harsher, and you'd expect more claims from bad weather. But in the summer, subsidence for property is more likely. Next, you have the awareness of the ability for someone to claim. If policyholders are more aware of their rights and aware of the processes and the existence of no win, no fee obligation settlements, it's increasingly easier to make claims. Global warming. Climate change results in increased frequency of extreme weather, which could result in increased claims. We also have exchange rates. This will depend on two things: where in the world business is written and where claims are made. Now, this typically affects larger companies and Lloyd syndicates more. This concludes the tutorial in relation to general insurance markets and the external environment.